It's now time for the third technical session, the topic being Companies Act. Before we begin, I'd like to introduce the chairman of the session along with the two speakers. Let me start by introducing the chairman, CA Anant Narayan Pai. Qualified as a chartered accountant, he is a partner at Pai Nayak and Associates and has been practicing since 1985. He was amongst the members of UTPI who had taken the initiative to form the branch and examination center at UTPI. He was also the secretary of the UTPI branch for the first 2 years and later became the chairman. As a student coordinator, he started the study circle meeting for students and also donated an office space to ICAI so as to set up a learning center at UTPI in memory of his father. It's a great pleasure to have you with us today, sir. The world has changed over the course of a few months, and there's no escaping that. With change in the world comes change in law, especially areas of law that are more important than ever. With this, I would like to introduce our first speaker, Mr. Dinesh Bhojani, who will update us on the recent changes in Schedule 3 under the Companies Act 2013. Jinesh Bhojani is a CA final student who is pursuing his articleship at Manubhai and Shah LLP, Ahmedabad. He graduated from R.J. Tibrewal Commerce College in 2020 and cleared his CA intermediate in May 2018 in his first attempt. He was the winner in CA Insta Quiz and was also amongst the top 25 quiz participants in Brainy Birbal Quiz organized by the Ahmedabad branch of ICAI. Apart from this, he has contributed articles for newsletters in Ahmedabad, Amritsar, Pune, and Kolkata branches of ICAI, and he was awarded the best article for the month of Jan 2021. He was also the winner in article writing competition on the topic Analysis of CSR Provisions of Companies Act 2013. The past year has not been kind to many people and companies financially. As an investor, you want to ensure that the company you're looking to buy shares from have good financial results. But apart from outstanding financial results, good corporate governance can also keep a company strong even at uncertain times. With this, I would like to introduce the second speaker, Mr. Ankul Mishra, who will brief us on how corporate governance is a perquisite today for a sustainable tomorrow. Ankul Mishra is a CA final student who is currently undergoing his articleship at SBA & Co. Indore. He has always been inclined towards research and paper presentation. He was awarded the best paper presenter. Apart from curricula, he has actively participated in sports like cricket and volleyball. It's a pleasure to have you with us, Jinesh and Ankul. Please give them a warm welcome. Over to you, Jinesh.
Can everyone hear me?
Yes, we can hear you.
Okay, perfect. I'll just start the screen sharing. Just let me know if the screen is visible to everyone.
Yes, Jinesh, it's clear.
Okay, I'll start the presentation. Any change, even a change for better, is always accompanied with discomforts. Namaskara, Mangalore. A very good afternoon to one and all present here. I am Jinesh Bhojani, and today I am here to present on the topic recent changes in Schedule 3 under the Companies Act. Well, to speak about the change, it has already taken place. And speaking about the adjoining discomfort, well, that is what exactly brings us here today. The agenda for the next half an hour of the presentation is to get rid of this discomfort. Now, we will be certainly discussing the changes as regards the Companies Act. But before we go ahead and do that, let us first understand what is Schedule 3. Well, Schedule 3 is a presentation framework which provides the manner in which every company registered under the Act shall prepare its financial statements. There are three divisions to the Schedule 3. Division 1, the IGAP reporting framework, Division 2, the Ind AS reporting framework, and Division 3, the Ind AS reporting framework for the NBFCs. Now, let us go ahead with the changes. Well, the first thing which anyone checks for any change or the amendment is the applicability of the change. Well, these changes are applicable with effect from 1st of April 2021. Hence, an inference can be taken that the financial statements having reporting date 31st March 2021 or before shall be as per the earlier disclosure requirements. Now, for the purpose of our discussion and for the ease of understanding, I have bifurcated the division-wise changes into two parts, the presentation-related changes and the additional disclosure requirements. Now, let us go ahead and discuss the changes in Division 1, the IGAP reporting framework. Firstly, the presentation-related changes. The first presentation-related change which we will be discussing is the rounding of requirements. Earlier, the rounding of requirements were not mandatory for the companies, and the denominations for rounding off of the amounts appearing in the financial statements were based on the turnover of the company. Now, the rounding of requirements are made mandatory for the companies, and the denominations for rounding off are to be decided based on the total income of the company and not the turnover of the company. This change will certainly improve the readability of the financial statements for the readers of the financial statement. Now, moving on to the next change, the changes in the nomenclature of tangible assets. Well, as you can see in the table, before amendment, the non-current assets appearing under the head property, plant and equipment were subclassified into tangible assets and intangible assets. Now, after the amendment, the non-current assets shall appear under the head property, plant and equipment and intangible assets and will be subclassified into property, plant and equipment and intangible assets. Well, this is a change which has been made corresponding to the change in the title of AS10. This change brings the nomenclature of Schedule 3 in lines with AS10 and AS26. Now, moving ahead with the next change, the reconciliation of property, plant and equipment and intangible assets. Well, the companies shall be required to provide a disclosure as enumerated in the presentation. Well, the disclosure shall be required in case where the change due to revaluation is 10% or more in the net carrying amount of the asset. Well, it is pertinent to note that the word used here is change, which shall mean that both increase as well as decrease in the value of assets shall be covered. In other words, both upward and downward revaluation shall be covered in the purview of this reconciliation. It is also pertinent to note that the change shall be disclosed separately for each class of asset. Further, where the company has revalued its property, plant and equipment, the company shall also disclose as to whether the revaluation is based on the valuation by a registered valuer or not. Now, moving on with the next change, the presentation of current maturities of long-term borrowings. Well, if I ask you that what is the most appropriate disclosure or the presentation of current maturities of long-term borrowings, giving you two options. The first, short-term borrowings, and the second, other current liabilities. Well, I am sure many of you might have thought that it should be disclosed under the head short-term borrowings. And as rightly thought by you, even MCA recognizes this. And hence, MCA has made a change requiring the current maturities of long-term borrowings to be disclosed under the head short-term borrowings. Earlier, the same was required to be disclosed under the head other current liabilities. Now, moving ahead with the next change, the presentation of security deposits given. Earlier, the security deposits given were required to be disclosed under the head long-term loans and advances. Now, the same is required to be presented under the head other non-current assets. Well, this is the change which has been made to correct the presentation of security deposits given, because the security deposits given are neither a loan nor an advance, and hence to group it under the head long-term loans and advances is kind of inappropriate. and hence MCA has rightly made a change in the presentation of security deposits given. Now, moving ahead with the next change and the last presentation related change in Division 1. The presentation of grants or donations received by the Section 8 companies. Well, the grants or the donations which are received by the Section 8 companies are required to be separately disclosed under the head Revenue from Operations. This amendment certainly removes the ambiguities prevailing in the minds of the management as regards the presentation of the grants or donations in case of Section 8 companies. Now, moving ahead with the next change, the additional disclosure requirements. The first additional disclosure requirement which we will be discussing is the shareholding of promoters. Well, for the purpose of this, the MCA has required the companies to make an additional disclosure, and the disclosure shall be made under the head share capital with respect to the shareholding of the promoters for each class of shares separately. A disclosure as enumerated in the presentation shall be provided by the companies. Well, let us decode why would MCA require the companies to make such a change or such a disclosure. Well, to think from an investor point of view, this information gives me an opportunity to assess the confidence of the promoters in the company. This information also provides me the necessary details of the number of shares held by each promoters, which will be showing the confidence of their in the company. Any change in the shareholding shall reflect the increase or the decrease of the confidence of promoters. Now, moving on to the next change, the aging schedule of trade payables. An aging schedule as enumerated in the presentation shall be required to be disclosed by the companies. For the purpose of this aging schedule, the companies shall be required to bifurcate the trade payables into disputed dues and undisputed dues. Further, the aging shall be done from the due date of payment. Well, I am sure seeing this aging schedule, many questions might be popping up in your mind right now. Like, what if the due date of payment is not specified? What is the meaning of the word disputed? Well, to address these questions, MCA has provided certain clarifications. To answer the first question, what if the due date of payment is not specified? Well, in that case, the aging shall be done from the date of transaction. The second question, what is the meaning of the word disputed? Well, the word disputed is not defined anywhere in Schedule 3, and hence an inference can be taken that the word disputed may mean both legal as well as other disputes. Now, moving on to the next change, which is not very much unlike this change, the aging of trade receivables. Well, an aging schedule, much like the aging schedule of trade payables, shall be required for trade receivables. But it is pertinent to note that there is a change in the number of aging buckets for trade receivables. There will be 5 aging buckets which will be required for the aging schedule of trade receivables, namely less than 6 months, 6 months to 1 year, 1 to 2 years, 2 to 3 years, and more than 3 years. Further, this covers the aging schedule of the disclosure related to the aging schedule. Well, why would MCA require the companies to make such type of disclosure? Well, the answer to that is that the management of any company generally reviews the aging schedule of both trade payables as well as trade receivables periodically. This information, however, is not available to the public, and it is rather an internal document which is not available in the public domain. Now, by way of this disclosure, the companies will be disclosing the information which they are reviewing periodically. Further, the investors will also get an opportunity to assess the aging of the trade receivables and payables. This will enhance the confidence of the investors in a way that they will be knowing the efficacy of the company in its collection of the dues. Further, going on to the next change, the utilization of borrowings. Well, this is a change which we are certainly aware of because this is something which we report in the CARO. Well, where the company has made any borrowings from banks or financial institutions, and where the company has not utilized those funds for the specific purpose for which it was taken. In that case, the company will be required to disclose the details of where the specified funds have been used. Well, this change brings the corresponding responsibility on the part of management to provide information both to the auditors as well as the readers of the financial statement as regards the utilization of borrowings. Further, the auditors will also get the required information which they want to report in CARO 2020. Moving on to the next change. The title deeds which are not held in the name of company and are regarding the immovable properties. Well, an additional disclosure is required in case where the title deeds of the immovable properties are not held in the name of company. Moving on to the next change. The details of Benami property held. Well, where any proceedings have been initiated or pending against the company under the Benami Transactions Prohibition Act, then the company shall be required to make certain additional disclosure in the Schedule 3. Well, this change has been brought corresponding to the change made in the CARO 2020, and it brings the responsibility on the part of management to provide information regarding the Benami properties held. Moving on to the next change, the aging schedule for capital work in progress and intangible assets under development. Well, an aging schedule, much like the aging schedule of trade payables, shall be required in case of capital work in progress and intangible assets under development. The aging buckets are same as the ones in the trade payables aging schedule, namely less than 1 year, 1 to 2 years, 2 to 3 years, and more than 3 years. The total of this aging schedule shall match with the corresponding line item appearing in the financial statements, namely the capital work in progress and the intangible assets under development. Moving on to the project completion schedule for CWIP and intangible assets under development. Well, a project completion schedule shall be required to be disclosed by the companies in case of the CWIP and the intangible assets under development. This aging schedule shall provide the particulars of the projects which are pending, and the companies will need to identify and assess the tentative dates for the projects which are in progress and when it will get completed. Further, the tentative dates will be classified and grouped into aging buckets as specified here. Moving on to the next change, the financial ratios. Well, for any investor, one of the many things which the investor assess is the financial ratios. Well, recognizing this, the MCA has required the companies to make the disclosure of the financial ratios in the financial statement itself. An explanation shall also be required to be given by the company in case any change in the ratio is more than 25% as compared to the last year. The financial ratios which are required to be disclosed are as enumerated here. Further, moving on to the next change and the last change for the purpose of Division 1 additional disclosure requirements, the cryptocurrency or virtual currency disclosure. Well, the MCA certainly recognizes the developments in the arena of cryptocurrency and virtual currency, and hence the MCA has required the companies which has traded or invested in cryptocurrencies to make certain disclosures. The first disclosure which is required is the profit or loss on the transactions in the cryptocurrency. The second disclosure which is required is the amount of currency held as at the reporting date by the companies. Well, that covers the Division 1 changes. Now, moving on to the other changes which are pertinent to note in case of Division 1. Well, these changes are the disclosures related to funds channelizing, borrowing related compliances, loans granted to promoters, directors, KMPs, and the other related parties, undisclosed income, and corporate social responsibility. Now, moving on to the changes in Division 2, the Ind AS reporting framework. First, the presentation related changes. Well, the first presentation related change which we will be discussing is the presentation of lease liabilities. Well, earlier the lease liabilities were classified under the head other current or non-current financial liabilities as the case may be. Now, the lease liabilities are required to be disclosed separately on the face of balance sheet under the head current or non-current financial liabilities. Now, moving on to the next change, the presentation of security deposits given. Well, this change is much alike the change in Division 1. Well, in this change, earlier the security deposits given were required to be disclosed under the head loans. Now it is required to be presented under the head other financial assets. This change certainly improves the correct presentation of security deposits given. Moving on to the next change, the presentation of current maturities of long-term borrowings. Even this change is much alike the change in Division 1. Earlier, the current maturities of long-term borrowings were required to be disclosed under the head other current financial liabilities. Now, the current maturities of long-term borrowings shall be required to be disclosed under the head short-term borrowings. This is certainly the most appropriate presentation of current maturities of long-term borrowings. Now, moving on to the next change, the presentation of prior period items with respect to equity share capital. Well, under the statement of changes in equity share capital due to prior period errors shall be required to be disclosed separately. Now, moving on to the other changes which are similar to Division 1. First, the rounding of requirement. Well, this is similar to Division 1 in a sense that earlier the rounding of requirements were also mandatory in the Division 2, but the denominations for rounding off were to be based on the turnover of the company. Now, the same is required to be based on the total income of the company. Moving on to the next change, reconciliation of property, plant and equipment and intangible assets. Well, this line item and the next line item, grants or donations, both are the changes which are same as Division 1. Moving on to the additional disclosure requirements. The first additional disclosure requirement in Division 2 changes is the valuation by registered valuer. The companies will be required to disclose whether the fair value of investment property or the revaluation of property, plant and equipment and intangible assets is based on a valuation by registered valuer or not. This is a change which is made corresponding to CARO 2020. Moving on to the next additional disclosure requirement, the aging schedule for trade receivables. Well, an aging schedule as enumerated in the presentation is required in case of trade receivables. The only change in this aging schedule as compared to the Division 1 aging schedule is that the trade receivables are bifurcated into trade receivables considered good, trade receivables which are credit impaired, and trade receivables which are having significant risk, increase in credit risk. So these shall be sub-bifurcated into disputed and undisputed dues. Apart from this, the other clarifications which were there in the aging schedule of trade payables shall hold true for aging of trade receivables as well. Moving on to the other additional disclosure requirements which are same as Division 1, namely the shareholding of promoters, aging of trade payables, title deeds of immovable properties not held in the name of company, loans granted to promoters, directors, KMPs, and other related parties, aging and completion schedule for CWIP and intangible assets under development, details of Benami properties held, financial ratios, disclosures related to funds channelizing, undisclosed income, cryptocurrency, and corporate social responsibility. Now, moving on to the changes in Division 3. the Ind AS reporting framework for Nbfcs. First, the presentation related changes. Well, all the presentation related changes are same as Division 1 or Division 2, namely the reconciliation of property, plant and equipment and intangible assets. Second, the statement of changes in equity. Now, moving ahead with the additional disclosure requirements. Well, the first and the only additional disclosure requirement, which is unlike the other, is the financial ratios. Well, the financial ratios as regards the capital to risk weighted assets ratio, CRAR, the tier 1 CRAR, the tier 2 CRAR, and the liquidity coverage ratio shall be required to be disclosed by the Nbfcs. Moving on to the other changes, which are similar to the ones as enumerated in Division 1 or Division 2, namely the aging of trade receivables and trade payables, the shareholding of promoters, the title deeds of immovable properties not held in the name of company, loans granted to promoters, directors, KMPs, and the other related parties, aging and completion schedule for CWIP and intangible assets under development, details of Benami property held, borrowing related compliances, disclosures related to fund channelizing, undisclosed income, cryptocurrency, and corporate social responsibility. Well, that brings us to the end of the presentation. In this era of changing environment, where there are many new enactments being proposed and where the existing ones are being changed or amended, it is very important for the chartered accountants to be the pioneer of the change and to be the torch bearer for the changes. To stay relevant, it is important for us to update and upgrade ourselves. As rightly said by Winston Churchill, to improve is to change. To be perfect is to change often. Thank you, everyone. This is Jinish Bojani. Thanks for being such a wonderful audience. Thank you.
I now request the next speaker, Uncle, to take over.
Good evening. Yes. Hi to everybody. Good evening. Am I audible?
Yes, sir. Yes, sir. Yes.
Okay. So I thank the Mangalore branch and its committee members and the student fraternity of whole of Mangalore branch for having me considered fit to be a chairperson of this excellent session. We heard one, Jinish Bojani, who has made an extensive coverage of amendments to Schedule 3. I will touch some of the aspects which I don't say he has missed out. He is a student, he has covered excellently. So now, if you all are the auditing students, if you see that, if you see what we are going to certify, true and fair review of the state of affairs, that is balance sheet, or true and fair review of profit or loss, or true and fair review of the cash flow, or true and fair review of the statement of changes in equity, if you follow Ind AS. There are certain aspects in amendment to Schedule 3 which, as an auditor, how we can certify, I mean, how we can watch on that. For example, the changes in promoters holding. He has already explained in detail. He was supposed to give the information as to promoters holding, what is the opening balance, what is the purchases, what is the sales, what is the closing, etc. Now the question arises, who is the promoter? If you see the amendment to Schedule 3, it says promoter as defined in Section 269 of Companies Act 2013. If you see Section 2, subsection 69, who can be a promoter? A promoter who has mentioned so in the prospectus, that is in case of listed company, or a promoter who has described as promoter in the annual return filed under Section 92 of Companies Act. This is 2. Or a promoter who is in control of the company directly or indirectly, maybe as a shareholder or maybe as a director, etc. Or a person according to whose instructions company is run, except in the professional capacity. Now the question arises whether the auditor has to certify that, audit this aspect. Because we are auditing true and fair of the balance sheet. If there is any wrong disclosure, in what way it affects the true and fair view of the balance sheet? You may be remembering, some of the chartered accountants here may be remembering, in old Schedule 6, which was there prior to 2012, there was one aspect, license capacity, installed capacity, etc., which the auditor need not cover in his audit report. Every balance sheet you used to find one note that the auditor is not giving his opinion on the license capacity, etc., since it is a technical nature. In the same way, I am of the opinion that this promoter shareholding is also, with the auditor, it's very difficult for the auditor to see who is the promoter, because it's a very wide, it's not a relative, it's a promoter. So there may be a names which may be intentionally missed out by the management, which how the auditor will come to know. This is one. The second aspect, if you see clearly in Schedule 3, there is one more, it's very, very, very risky. Transactions with struck-off companies. The auditor, the management has to disclose the transactions with struck-off companies. What is struck-off company? A company with name is struck off by registrar of company under the old act or under the new act. So there may be n number of companies may be having transactions with the company in the normal course. So how to find out the struck-off companies? Now it may be possible or may not be possible for management of the company, but the auditor how to find out? So I don't think it may be, again the institute has to come out with a guidance note. The responsibility of the auditor in this connection of struck-off company. And third aspect is a willful defaulter. This I think we may have to, because a willful defaulter is defined as a person declared as willful defaulter by the bank or financial institution. So I think this we can find out, because first we have to find out whether he is a defaulter or not. If he is a defaulter, then I think we may have to approach the bank or financial institution who has advanced money to the company, whether he has been declared as a willful defaulter. And next very important is channelizing the funds. Suppose the company has borrowed some money from one person, or company has accepted share premium, and out of that company has lent the money to certain other person, then this company will be considered intermediary and certain other person, and that certain other person has given to somebody, then I think we have to make a disclosure. This is very, very risky. The auditor must be very careful in this aspect. So there are many aspects. For example, rounding off. Next year onwards, our life will become miserable, because we will have to find one software to eliminate the rounding of errors. Whenever you round off, there will be some errors. So we have to find out how to round off the errors. So is in line. Ankur is online. Gautam?
Yes, sir, I am here.
Ankur is online. So I will cover the balance part afterwards. So over to Ankur.
Shall I begin?
Yes.
A lie keeps growing and growing until it is clear. Every time we use lie as an instrument to win or way towards goal, we fail to comprehend how it will hurt us in the long run. Topic of corporate governance might encourage wild speculation in the period of great, or some would say epochal change. Some might see the demise of big corporations or the emergence of new organizations with intelligent robots playing the role of the board. Greetings of the day to the respected dignitaries and the audience. I am Anukul Mishra from Indore, presenting on the topic Corporate Governance, a prerequisite today for a sustainable tomorrow. What is corporate governance? Governance is considered a relationship between various stakeholders of an organization. Stakeholders can be understood as the shareholders, directors, employees, and also the general public. Hence, corporate governance can be understood as a relationship that exists between the shareholders, stakeholders, and employees of an organization. But corporate governance in India is also a set of internal controls, policies, and procedures which form the framework of a company's operations and its dealings with various stakeholders. Corporate governance is evolved around key principles which form the base of rules and guidelines set for the corporate. The first one is the transparency. Disclosure of the relevant information about corporate in timely and accurate manner is necessary. It helps stakeholders to know their rights and day-to-day activity of the corporate. The second principle is accountability. It ensures that the liability of the person who takes decision for interest of the others. Hence, persons like managers, chairmen, directors, or any other officers shall be held accountable to other stakeholders of the corporate. Another principle is of independence. Independence of the top manager is important for a smooth functioning of the corporate. Board of Directors must work without the interference of any interested party in the corporate. What is the need of corporate governance? There are various factors which can be summarized as follows. The first one is the wide spread of shareholders. Today, a company has very large number of shareholders spread all over the nation and even the world. And the majority of shareholders being unorganized, having an indifferent attitude towards the corporate affairs. The idea of shareholder democracy remains confined only to the law and article of association, which requires a practical implementation through a code of conduct of corporate governance. The pattern of corporate ownership has changed considerably, and in the present day times, with institutional investors, both foreign as well as Indian, and the mutual fund becoming largest shareholders in corporate private sector, these investors has become greatest challenge to corporate management, forcing the latter to abide by some established code of corporate governance to build up its image in the society. Corporate scams or frauds in the recent past year have shaken public confidence in corporate management. The event of Harshad Mehta scandal, which is perhaps one of the biggest scandals, is in the heart and mind of all, connected with corporate shareholding or otherwise being educated and socially conscious. The need for corporate governance is then imperative for reviving investors' confidence in the corporate sector towards the economic development of the society. Society of today holds greater expectation of the corporate sector in terms of reasonable price, better quality, pollution for the best management of the company in economic and social terms. Thus, the greater expectations of the society from the corporate sector is another reason for having a good corporate management. The next one is the hostile takeovers. Hostile takeovers of corporation witnessed in several countries put a question mark on the efficiency of management of takeover companies. This factor also points out the need of corporate governance in the form of an efficient mode of conduct for corporate management. It has been observed both in the developing and the developed economies that there has been a great increase in the monetary payments to top-level corporate executives. There is no justification for exorbitant payments to top-ranking managers out of corporate funds, which are a property of the shareholders and the society. This factor thus necessitates the corporate governance to contain the ill practices of top management of the companies. Last but not the least, desire of more and more Indian companies to get listed on international stock exchange also focuses on a need for corporate governance. In fact, corporate governance has become a buzzword in the corporate sector. There is no doubt that international capital market recognizes only companies with well managed according to the standard codes of corporate governance. Now, let us understand how the corporate governance has been painted in India. The corporate world has seen numerous companies getting dissolved in the last few decades owing to scandalous reasons. It happened mainly as the top authorities didn't allow any business ethics, chose to show higher current profits, didn't allow auditors to curb improper policies, allowed greed to prosper, sacrificed long-term profits, among others. In the early 80s and 90s, as world institutions looked forward to establish branches in India, the need for good corporate administration arose. In 1996, the Chamber of Indian Industry (CII) proposed a corporate administration code where it talked about how the corporate governance framework would take care of practices and methods required while running the company management. The Kumar Mangalam Birla Committee on Corporate Governance suggested that the listed companies should disclose their annual reports separately, provide full information to the shareholders, and secure the right of the investors. India has seen a rise in the corporate frauds and mismanagement in the business field in the past few years. Thus, India is believed to have one of the most stringent and rigorous corporate governance laws in place. Primarily, the following statutes govern them. Companies Act 2013, Securities and Exchange Board of India (SEBI), the SEBI Insider Trading Regulations 2015, SEBI Issue of Capital and Disclosure Requirements Regulations 2018, Guidelines for CSR Expenditure of Central Public Enterprises 2018. The provisions of all such statutes are summarized as follows. The first one and most important, the Board of Directors. The Desirable Corporate Governance Code by CII in 1998 for the first time introduced the concept of independent directors for listed companies and compensation paid to them. The Kumar Mangalam Birla Committee 2000 then suggested that for a company with an executive chairman, at least one half of the board should be independent directors, or else at least 1/3. The updated clause of 49 of SEBI, based on the report of Narayan Murthy Committee, further elaborates the definition of independent directors and also requires listed company to have an optimum combination of executive and non-executive directors. The Companies Act 2013 introduced the requirement of appointing a resident director and a woman director. The term key managerial person has also been defined in the Companies Act, comprising of chief executive officer, managing director, manager, company secretary, full-time director, chief financial officer, and any such other officer as may be prescribed. The second point is Audit Committee. The Audit Committee's role flows directly from the board's oversight function and delegation to various committees. It acts as an oversight body for transparent, effective anti-fraud and risk management mechanism and efficient internal control and external audit functions. As per Section 177 of Companies Act 2013, read with Rule 6 of Companies Meetings and Board and its Power Rules 2014, every listed company and all other public companies with paid-up share capital of rupees 10 crore or more, or having turnover of rupees 100 crores or more, or having an aggregate outstanding loans, borrowings, debentures, and deposits exceeding rupees 50 crores or more, to have an audit committee which shall consist of not less than 3 directors and such other number as the board may determine, of which 2/3 of the total number of members shall be directors other than managing or whole-time directors. The rationale behind having separate provisions with the respect of subsidiary companies in the revised clause 49 was the need for the board of holding company to have some independent link with the board of the subsidiary and provide necessary oversights. Hence, on the recommendations of Narayan Murthy Committee to make provisions relating to the composition of board of directors of the holding company to be made applicable to the composition of board of directors of subsidiary company, and to have at least one independent director on the board of directors of the holding company of the board, were incorporated in the revised clause 49 of the listing agreement. The definition of subsidiary company is also widened by the Companies Act 2013 to include the joint venture companies and their associate companies. As one of its mandatory recommendations, the Kumar Mangalam Birla Committee propounded the need to form a board committee under the chairmanship of a non-executive director to specifically look into the redressing of shareholder complaints like transfer of shares, non-receipt of balance sheet, non-receipt of declared dividends, etc. The committee believed that the formation of shareholders grievance committee would help to focus the attention of the company on shareholders grievances and sensitize the management to redress the grievances. Thus, The Companies Act 2013 now mandate companies with more than 1,000 shareholders, debenture holders, deposit holders, and any other security holders at any time during a financial year required to constitute a stakeholders relationship committee consisting of a chairperson who shall be a non-executive director and such other member as may be decided by the board to resolve the grievances of the security. The Kumar Mangalam Birla Committee report included mandatory management decision and analysis segment of annual report that includes discussion of the industry structure and development, opportunities, threats, outlook, risk, etc., as well as the financial and operational performance and managerial development in human resource industry relations. The Companies Act 2013 and revised clause 49 specify requirements related to risk management. Here, the audit committee and the independent directors of the company are entrusted with the responsibility of evaluating the robustness of the risk management systems and policy laid down by the board. The next provision here is executive remuneration. The overriding principles in respect of the director's remuneration is that of openness, and shareholders are entitled to full and clear statements of benefits available to directors. The Companies Act 2013 and revised clause 49 mandate the formation of a nomination and remuneration committee comprising of at least 3 directors, all of whom shall be executive directors and at least half shall be independent. The nomination and remuneration committee is to ensure that the level and composition of remuneration is reasonable and sufficient. The relationship of remuneration to performance is clear and meet appropriate performance benchmarks. The remuneration to directors, key managerial person, and senior management involves a balance between fixed and incentive pay, reflecting short and long-term performance obligations. There are also some compulsory disclosures to be made in the section on the corporate governance of the annual report. Another most important provision, directors' responsibilities. To promote better disclosures and transparency, the Companies Act 2013 requires the company's annual report to include a director's responsibility statement stating the following. Applicable accounting standards has been followed in the preparation of annual accounts. The director has selected such accounting policies and applied them consistently and made judgments and estimates that are reasonable and prudent so as to give a true and fair view of the state of the affairs of the company. Proper and sufficient care of the maintenance of adequate records in accordance with the provisions of this act for the safeguarding of assets and preventing, detecting fraud and other irregularities. The annual accounts of the company are prepared on a going concern basis. The directors have laid down internal financial controls to be followed by the company, and that such internal financial controls are adequate and were operating effectively. The narration committee for the first time required the signing officers to declare that they are responsible for establishing and maintaining internal controls which have been designed to ensure that the material information is periodically made known to them. So, the clause 49 requires the CEO and CFO to certify the board annual financial statements in prescribed format and establishing internal control systems and processes in the company. The CEOs and the CFOs are thus accountable for putting in place robust risk management and internal control systems for their organization's business processes. The Companies Act 2013 also brought much rigor to internal control certification by making it as one of the part of director's responsibility statement. A code of conduct creates a set of rules that become a standard for all those who participate in the group and exist for the express purpose of the demonstrating professional behavior by the members of the organization. Yes, I'm talking about the ethics. The clause 49 incorporated the recommendations mandating the directors of every listed company to lay down a code of conduct and post the code of conduct on the company's website. The board members and all the senior management personnel are required to affirm compliance with the code annually and include a declaration to this effect by the CEO in the annual report. The recommendation of Narayan Murthy Committee to make Audit Committee responsible for reviewing the functioning of the whistleblower mechanism where it exists is incorporated in clause 49. The Companies Act 2013 and revised clause 49 mandate establishing the whistleblower mechanism to let employees and directors blow whistles on financial and non-financial wrongdoings, and also that such mechanism should provide protection to the whistleblower from victimization and provide direct access to the chairman of the audit committee in exceptional cases. This was all about the corporate governance picture painted till now in India. It has been 28 years since the 1991 reforms which ended the license Raj in India. Many large corporates grew born as family-owned enterprises gradually embraced the way of transparency and good governance, indicating the fact that clean and well-managed companies can succeed in India. However, 2018 witnessed the opposite end of a corporate spectrum, with major fiascos popping out, Indian promoters making headlines almost every month. ILNFS, Tata Group, ICICI Bank, and whatnot. Let's have a look at 3 cases of the recent past. Surprisingly, the names include not only the smaller companies, but even the biggest corporate houses that once hold the flag of corporate governance high. The first one. Yes, by the picture, everyone can guess the poster girl of good governance. The ICICI Bank, India's leading lender, was marred by allegations of corporate misgovernance, nepotism, and conflict of interest. The case pertains to a loan of about INR 3,250 crores to Videocon Group in 2012 and involvement of the MD and CEO Chanda Kochhar's husband in the process of loan sanctioning. Despite several allegations, the board of directors allowed coaches present in the company. Worse happened when there was a whistleblower with detailed allegations. The board publicly supported the CEO before an investigation was completed. A brilliant example of how directors toe to the line of celebrity CEOs. What is the cost of lies? It's not that we will mistake them for the truth. The real danger is that if we hear enough lies, then we no longer recognize the truth. The next case is of Yes Bank or Oh No Bank. Yes Bank was growing its loan asset at an impressive CAGR of around 40% from financial year 15 to 18, which included relatively riskier segments like developer funding. In 2015, the RBI decided to conduct an asset quality review AQR of the balance sheets of the bank. It found out that the banks were indulging in account jugglery. They were not fully disclosing their bad debts. At a time when most of the banks were grappling with rising NPAs, Yes Bank's NPAs was consistently below 2%. It was found that 5.5 more NPAs were in Yes Bank's book than disclosed by the bank in the financial year 19. Last but not the least, the case of Gitanjali James is also an example which raises serious questions on the role of independent directors, auditors, and credit rating agencies. Mehul Choksi and nephew Nirav Modi were allegedly involved in the outright fraud amounting to INR 13,000 crores. Gitanjali Group companies allegedly colluded with the Punjab National Bank officials to secure fraudulent, unauthorized letter of undertaking and foreign letters of credit. Mehul Choksi also allegedly siphoned off funds from the companies through shell companies. Choksi and Nirav Modi left India and their companies defunct. Gitanjali's share fell over by 90% as was ultimately suspended by both NSE and BSE. This case deserves a special cameo in this article as the story is no less than a Bollywood flick. But what is the future? In the last decade, corporate fraud and governance failure is occurring frequently, which is why we require good corporate governance in India. India provides proper norms and laws aligned with international requirements to govern a corporate. Stakeholders place a complete faith on the expertise and wisdom of the auditors, independent directors, and the credit rating agencies. Thus, these pillars of corporate governance must be prevented as they matter the most: the auditors, independent directors, and the credit rating agencies. But in the merit list of non-performers, independent directors deserve a special place. In the light of the recent cases of the alleged fraud and the irregularity, it turns out that the independent directors in most cases is still loyal to the promoter's line, primarily because directors are handpicked by the promoter or the CEOs. Directors also do not challenge the promoters as they do not have skin in the game. But based on the recently constituted committee under the leadership of Uday Kotak, SEBI has implemented some sweeping changes to improve governance standards. Most significant one include that the minimum of 6 independent directors on board, including a women director, listing of competencies of every director. It has also mandated separation of CEO, MD, and chairperson for top 500 listed entities by market capitalization with effect from April 2020, and the chairperson can no longer be related to MD or CEO. If it is implemented in the spirit, this could be a positive step towards the separation of professionalism and kinship, ultimately leading to higher independence of the board. When the going gets tough, the tough goes out. Who said this? The tough auditor. In 2018, India witnessed an audit crisis. Auditors, over 204 listed firms resigned, citing vague reasons such as lack of adequate information and preoccupation with other assignments. The comparable figure for 16-17 was just 18. Such an exodus list of auditors raises serious questions over the standard of corporate governance in India, and also highlight the fact that when the going gets tough, the auditors can safely exit with impunity. Some part of the auditor exit is attributable to the tough judgments, disallowing certain auditors to perform audit functions for a few more years because of sins of their past. That a tough action causes you to walk away from certain customers now tells us more about their customers and the auditor's acceptance of their actions. But the SEBI has made it mandatory for companies to disclose the credentials of the auditors, including fees and any material changes in the fee structure. Most importantly, auditors and independent directors will have to provide detailed reasons if they resign. Further, some auditors have been banned for the period, like PricewaterhouseCoopers was banned for 2 years for its role in the Satyam fraud, and Deloitte faces a 5-year ban for it did or did not do in the IL and FS situation. The third pillar, most important of all, credit rating agencies. The credit rating agencies has also received a fair share of the blame on the back of recent financial frauds. CRAs have repeatedly failed to alert investors about implementing default, be it the case of ILNFS, Z Group, DHFL, or many. Downgrading bond ratings post-default has raised serious questions over the issue pair model, wherein the CRS could develop a mutual understanding with corporates and not act in the best interest of the shareholders. For instance, the SFIO has recently summoned care rating agencies, ICRA Limited, India Rating and Research Private Limited, Brickwork Rating India Private Limited on their alleged role in the rating of IL and FS financial services debt papers. Recent reports suggest that the SEBI and RBI are also reviewing the business models of credit rating agencies to prevent rating shoppings and ensuring greater accountability of rating agencies. Proposals such as the dual ratings and the transparent bidding process for selection of credit rating agencies are being considered. Rules which may compel rating agencies to provide detailed explanations in case of sudden downgrades are also being considered. These are some welcoming changes which were long overdue, but one has to see how these are implemented, because even the best regulations can fail if not implemented in letter and spirit. We need to understand that the life can only be understood backwards, but it must be lived forwards. While there is a long anger against these issues of corporate governance, there is no enforcement of our laws by the authorities. So, as investors and as the participants, we need to be extra careful about governance, because every red flag is a danger sign. Today, the more we put shady promoters in prison, the better our corporate governance will be, but will the authorities oblige? So, although India has a long way to be ranked among the best in the world in corporate governance, the driver is exactly right. The Indian market has now realized that the companies need financial and human capital in order to grow to scales necessary to survive in the international competition. They also understand that such capital will not be available in a non-transparent corporate regime that is bereft of international quality of disclosures and accountability. It is precisely this realization which is driving the corporate governance movement in India, and which has greater chances of delivering substance rather than taking mandated governance strategies. To conclude, I would say the corporate governance is not the future of India. It is the present which will lead the future. Thank you.
Yes, Gautam.
Hello.
Yeah.
I now request the session chairman to take over.
Yeah. My compliments to Ankur. He has made such an extensive topic, corporate governance, quite simpler by giving practical examples of S-Bank, Gitanjali, GEMS, and then ICSA. Really, my compliments to him. Yesterday only we had a discussion on this paper, and I have seen not only the PowerPoint presentation, he had made an extensive note of that. So it's an excellent presentation. My compliments to Ankur. He has rightly pointed out, in spite of so many steps taken by SEBI, like woman director, independent director, making rating compulsory, and corporate governance reporting, even then these frauds are taking place. So my message to all the CS students is we should join together in support the government in bringing down or avoiding frauds rather than finding out frauds later. So my compliments to you. Now coming back to the first presentation, Ginish's presentation, I have already covered certain aspects. One thing I missed out there is you might have seen the amendment to CARO 2020. If you read the additional paragraphs added in, additional clauses added in CARO 2020, compare that with Schedule 3, there are certain common things. For example, the Benami transaction finds place in both the places, both in Schedule 3 as well as CARO. Maybe then there's reporting on stock statement where the borrowing is more than 5 crores and there's the quarterly stock statement. If there is any variation in books of accounts, which the management now has to disclose in Schedule 3, which the auditor is required to report as per CARO. Then undisclosed income, that is also finding place in both the places, in CARO as well as Schedule 3. And very important, channelizing the funds. For example, a company borrows funds for the purpose of subsidiary, associates or joint ventures. Then also it covers under CARO. It also required to be disclosed in Schedule 3. So I think the life of the auditor made little easier, because earlier the management was not required to report. Now the management is required to report or disclose in the accounts, and which the auditor is required to report. So, but lastly, I strongly believe that, see, there are two things. One is accounting aspect, second is disclosure aspect. So sometimes the auditor has to strongly rely upon his client or the company or the executives for many of the informations which may not be correct, because he cannot have a 100% confidence or 100% comfort level on that. So whenever there is any problems, the blame may be on the auditors. So I strongly believe certain aspects like promoter shareholding, maybe relations with stock op companies, maybe certain other aspects with the institute has to the disclosure should be there, but auditor should not be made responsible for any wrong disclosure therein. For such items, the management must be made responsible, because those aspects which the auditor may find it very difficult to verify and certify. So my congratulations to both Jinish and Ankur for the excellent presentation. I once again thank Bangalore branch for giving me an opportunity to address this 1,000, because I'm told that the total registration is 1,200 and at present about 650 students are online. So it is a great privilege for me to address such a vast student from all over India. Thank you.
So for your valuable inputs and examples, and thank you Jinesh and Uncle for providing us with valuable information on the relevant changes in Companies Act, especially with regards to cryptocurrency and corporate governance.